Back to Investment 360. Chinese equity markets are pricing for a cataclysm despite being supported by an economy growing at 7.5% per annum, certainly not 6.5% per annum. Stock valuations in China look very cheap, but why? Much has been said about the popping of a credit bubble, but could it be that things have been overdone? Joining us from Cape Town to share his views on China is a Chinese expert, Liang Du. Liang, thanks for joining us today. I suppose a fitting day to talk about China in light of the Chinese PMI figures which came through today, showing those figures sitting at a 4-month high for August. So let's start off with that. I mean, your assessment as to how strong the economy is right now, and the thoughts on how stocks are perhaps disconnected from what's happening in terms of growth prospects.
Absolutely. I think what we're seeing in China at the moment is that it's certainly not growing as fast as it used to be. So I think investors has gotten very much used to 10% growth per annum. And I think a slowdown now to about 7.5%, and certainly the governments have made reassurances that it will be growing between 7 and 7.5 for the rest of the year. And in fact, going forward, it's likely to be even slower than that. Mm-hmm. So I think, in terms of growth, is that China will still continue to grow, but the pace of growth will be a lot slower.
Mm-hmm. Liang, just to come in here, I mean, Sammy is quite a strong word there, cataclysm, or there's a big event coming, and a lot's been said about this credit bubble in China. But I just wanted to ask, I mean, this is still an economy growing at 3 times the speed of the American economy, and it is already the second biggest economy in the world. So there seems like there is a really big disconnect there between what the equity market's saying and what the fundamental prospects are for the economy. Perhaps you could just give us your thoughts on the degree of this problem in the credit bubble and the opportunity in the equity market, if you think that things aren't going to be as bad as they appear to be at the moment.
Absolutely. So I think what people are really worried about, I think there's a very, very big misnomer. So firstly, listed companies in China, the debt on their balance sheet is only about 10% of GDP. When you compare that to listed companies, let's say in the US, Europe, and South Africa, it's far higher than that. It's about 40 to 50% of GDP. The big worry, what people have seen, is that bank loans in China, so banks actually advancing loans, that makes up almost 80% of GDP, and that number is extremely high. So to put that in perspective, the US probably sits about 60%, and South Africa sits about 70%. And almost, like I said, China is about 80 to GDP, and 40% of that happened during the 2009 financial crisis. So it's the stimulus package that the government has put through. So this has worried a lot of people because the theory behind that is that all this loan has gone out. It supported the economy. They've constructed a lot of these useless infrastructure, and now it's coming back to bite them. Now, part of that story is true. So certainly a lot of infrastructure was built during 2009 stimulus. On the other side of that, we have to say that when you look at China, there's 2 things I think that kind of negate some of those fears. The first thing is that most of the bonds in China and the loans in China are held by Chinese investors. Foreigners do not own almost any of that, and foreigners in fact cannot put capital into China. So there's no risk of a massive withdrawal of liquidity from the financial market. Mm-hmm. The second thing that mitigates it is, of course, the Chinese government has an extremely strong balance sheet and is very well capable at the current size of the credit bubble to be able to help out companies. I think a lot of people tend to forget that China is actually, a lot of it is owned by the government, so they won't be bailing out, let's say, companies, but rather just helping themselves. So I think the 2 things partially mitigate that risk. And finally, as Warren, as you've mentioned, it's still growing at 5, 6%, 7.5% in fact. And with high growth, some of that problem will be moved away from that. I think what's attractive for us is that the market has certainly priced that in. So if for example, if we do in fact see a massive slowdown in China and no growth in China, let's say over the next 5 years or so, then the market has priced it in. The market has been so negative in China, its valuation is so different from the rest of the global markets that's been priced in. Vice versa, if the problem does not materialize and the Chinese government slowly rebalances and make use of the spending that they've made, there's fantastic returns to be had in China.
Just contrast that equity valuation, Liang, for us against what's going on in the money market, because my understanding would be that the first place you'd see the panic if there is problems with the systemic credit in the system or problems with the credit system is in the money markets. Have money market fund rates started to rise almost as LIBOR did into November 2008 when everyone in the system started getting worried about being able to pay their obligations?
Absolutely. So in June this year, this definitely did happen. So there was a bit of a liquidity dry up, and that was partially driven by government policy. So as the new leadership came into power, one of the things they wanted to do is to really, they've already mentioned it in policy, they've told the banks that they will no longer tolerate wasteful lending, and they want direct lending to productive sectors of the economy, namely the smaller companies. So what they've done in June, knowing that there's a lot of wealth management products coming to mature, what they've done is they dried up a little bit of the liquidity, showing their intent. I think that was recovered very, very quickly. So by July, all of that was gone. There was a seasonal effect in June as well in terms of liquidity shortages. So I think on the one hand, that is a good indicator. On the other hand, if you look at Chinese data, it happens quite often. We're talking about every year there'll be 5, 6 such spikes. And they do not portray something longer term.
Mm-hmm. Let's talk about investing in China right now, because we know that there's always the indirect method. You can invest in companies in South Africa that have strong Chinese presence. Of course, Naspers comes to mind as one of them. But when it comes to actually more direct investing opportunities, what are the entry points right now? What are the barriers? And how easy is it to go about getting exposure to the Chinese economy?
Unfortunately, it's very, very hard to get exposure to the Chinese economy, and one of the things you require is actually a license to invest in China. So they don't allow just anyone to go in there. You have to get approved, and that what has resulted is that foreigners only own about 1.2% of the Chinese equity market, which is an extremely small number for such a large economy and such a large market. So in terms of return, if you look at, because of the difficulty to access, if you compare and contrast, let's say the MSCI China, which is basically the Chinese basket that's listed in Hong Kong and overseas and accessible to foreigners, versus, let's say, the Shanghai Composite, which takes the Chinese, actual Chinese shares listed in China. The difference in performance is about 14% in favor of the Chinese composite per annum over the last almost 20 years. So you can see that investors tend to pay a premium to get access to China.
Mm-hmm. So, I mean, is that regulation changing going forward right now? That 1.2% of foreigners, as you say, right now invest in the equity market. But do you think regulation is going to favor more foreign investment in equities?
Absolutely. I think if you look at Chinese regulators, what they've done is they've quadrupled the size of the quota. So they've allowed, so basically what they have allowed is created a policy for foreigners to earn, they say, about 4% of the market. Although they haven't issued the quota yet, the policy is in place. And I think going forward, they would open it up more and more and more. And that's part of a drive of the new leadership, is to normalize the Chinese capital account, is to they're trying to join the rest of the world in terms of in the side of finance and in the side of capital.
Liang, just to take us through the broader term plans and ambitions of the country. Obviously, the US holds the status as reserve currency at the moment. Is that something that China want to assume at some point in the future? And perhaps you can just color that your answer with a bit of a discussion around how they're liberalizing the currency, because we know that they have pegged that to the dollar, but that's become a little bit more flexible in recent times. Perhaps you could just give us a roadmap for the years ahead in terms of what China wants to attain in terms of its status.
Sure. I think on that side, you're absolutely correct. So the RMB has been allowed to be in a managed float since about 2006, 2007, and they've upped the speed of the float. So the RMB have been strengthening faster and faster. So what they certainly want to do is there's a lot of benefits of being a reserve currency, and one of the main things is, of course, it gives you a stable liquid capital pool, and the Chinese is more driven towards that. So the steps you can see that they've been taking in China in order to open all of it up is first liberalizing their own banking sector. So what they've done is started to liberalize interest rates in China, so to allow banks to actually set their own lending rates as well as their own deposit rates in the coming years. But I think the focus on the capital account is not actually the main focus of the Chinese government. That is almost secondary, and it's secondary to what they really want to achieve, which is let the Chinese people live a better life. So they want to switch away China from being the factory of the world to be a country that's more sustainable based on their own consumption and based on improving wealth of the people. And part of that is, of course, you need to liberalize currencies, you need to liberalize interest rates so that the market becomes more market-driven. When China was a small country, it was easy to direct where investment goes and to have a successful country where infrastructure needed. Now that it's a bigger country, they realize that they need free markets to take over so that money is not wasted and it's going to the right places.
Let's turn our attention to the debt market and specifically hone in on the opportunities in corporate debt right now, because you talked about at the beginning around companies are only having around overall 10% of debt on their balance sheet. So there's still room to grow when it comes to tapping into the leverage opportunities for those companies. But what opportunities does corporate debt present to investors right now offshore?
Okay, so for an offshore investor who actually can get access to the Chinese debt market, firstly, there's a free arbitrage. What I mean by that is that Chinese interest rates are a lot higher than US interest rates. Chinese government debt, just government debt by itself, for example, is sitting at about 4.5% interest relative to US debt. And the forward market, which in the efficient market, the interest rate differential is hedged out. But in China, because people can't get access, that market is not hedged out. So what tends to happen is you can just buy Chinese debt, hedge out the currency risk to, let's say, US dollars, and immediately earn an extra 1% to 1.5%. So there's this arbitrage opportunity. Now, if you take it a step further, then you're able to hold some risk. The second step further is that, as I've mentioned, there's a lot of very, very strong Chinese corporate short-term debt in China. We're talking about 3 to 6 year debt on unbelievable balance sheets, great companies sitting at credit spreads of 300 to 400 basis points. And I think that just comes from the market not being open to investors and the market not being deep enough yet for people to realize that. So short-term credit spreads are much wider than they should be in China. Finally, if you're really, really, really brave, as you can well imagine, the small banks, not small banks, the private banks, they're still very large banks, but private banks in China, their debt has really, really blown out, as you can imagine. So if you're very brave and believe that there is no credit problem, then that's a great opportunity as well to buy some.
Liang, we just wanted to, a final question there, understand a little bit more about the consumer, I guess the retail investors' role in the Chinese equity and debt markets. There is a view that the participation of retail investors has multiple effects on the stock exchange, but one of them is that they can really add to a momentum effect either on the way up or the way down. I just wanted to get your perspective on how many retail investors, or roughly how many retail investors there are in the Chinese equity market. That's obviously Chinese citizens, and perhaps if you have any figures on the debt market, just to give us a feel for the participation that the man in the street in China has in their own capital market.
Absolutely. In terms of stock accounts, there's about 110 million stock accounts in China. In terms of stock accounts with active money, so people are actually moving their money in and out of it and buying things, we're sitting at about 54 million people in China. And you're absolutely right, that contributes to a lot of opportunities in the market because the retail investors in China tend to overreact a hell of a lot. One of the funniest things was perhaps the wine stocks. So what happened in China was they had the policy of clamping down on corruption. And the retail investors were absolutely convinced that this means that no one's going to buy wine anymore. So wine stocks absolutely crashed in 1 month for ridiculous numbers. We're talking about 40, 50% falls, and those were to be recovered within 1.5 months.
Yeah.
So they play a very, very large role in China. But that also means that it's a great place to be because there are opportunities to make money in China. On the bond markets, they're not really participating there. So the bond markets, the Chinese investors aren't really participating there. And I don't think going forward it's attractive to a retail investor to be in bonds.
Liang, thanks for shedding some light on investment prospects in China. Appreciate your time tonight. Liang Du, Portfolio Manager at Prescient Asset Management. That's it for Investment 360 this evening. Thanks, of course, to my co-host Warren Dick. Remember, if you'd like to send us some feedback and suggest topics, you can contact Warren on @Warren_Dick.